Howdy, this is Aardvark Tax TV. I'm Sean Kennefic. I'm an enrolled agent and customer service representative here at Aardvark Tax. Today we're going to talk about tax-deferred exchanges of rental property. This video is part of a complete continuing education course available at our website, www.aardvarktax.com. And now on to tax-deferred exchanges. In a typical sales transaction, the property owner is taxed on any gain realized from a sale unless an exclusion exists, such as the one for a primary residence. No such exclusions exist for rental property though, but you can defer the tax ramifications of the gain to a future date if you use a Section 1031 exchange. Section 1031 of the Internal Revenue Code provides that no gain or loss shall be recognized on an exchange of property to another if it's also held for productive use in a trade, business, or as an investment. A tax-deferred exchange is a method by which a property owner sells one or more properties and replaces it with properties of like kind. For instance, a rental real estate property for another rental real estate property, or a single rental real estate property for several rental real estate properties. The theory behind Section 1031 is that taxpayers' investment is still the same, only the form has changed. When you defer tax in a Section 1031 exchange, you basically have more money available to invest in replacement property. In effect, you're receiving an interest-free loan from the federal government in the amount that you would have paid in taxes. A like-kind exchange under Section 1031 is tax-deferred, not tax-free. When the replacement property is ultimately sold, the original deferred gain, plus any additional gain realized since the purchase of the replacement property, is subject to tax in the year that the asset is sold. There are 4 requirements for a valid exchange. The first is about the type of property. Many different types of property can be exchanged, including property that isn't real estate. Certain types of property are specifically excluded from 1031 treatment. These properties include inventories, stocks, bonds or notes, interests in partnerships, certificates of trusts, and some other assets listed in the tax text. In general, if property is not specifically excluded, it qualifies for tax-deferred treatment. The second requirement is that both the relinquished property and the replacement property must be held for productive use in a trade, business, or as an investment. For example, a taxpayer's personal residence will not qualify for a Section 1031 exchange, even if the gain on the property is more than the homeowner's exclusion will cover. The third requirement is that replacement property acquired in an exchange must be like kind to the property being relinquished. All qualifying real estate property located in the United States is considered like kind. Keep in mind, though, that property located outside the United States is not considered like kind to that is within the United States. Personal property such as furniture and computers that are relinquished must be either like kind or like maker's class to the personal property which is being acquired. The fourth requirement is that the relinquished property must be exchanged for other property with no cash touching the hands or the bank accounts of the taxpayer during the process. Now, many exchanges might take place simultaneously, with the sale of one happening at the same time as the purchase of another. But in other cases, in fact many other cases, there are delays that make trading properties at the same time difficult. When you have such a delay, you must use a qualified intermediary to facilitate the sale. So that's the only way that you can still meet the requirements of Section 1031. Qualified intermediaries cannot be the taxpayer or an agent of the taxpayer. For purposes of this regulation, that means a taxpayer cannot have an intermediary who has acted as the taxpayer's employee, attorney, accountant, investment banker, broker, or real estate agent within the 2-year period preceding the date of the transfer. These people are disqualified from being a qualified intermediary because they are considered a taxpayer's agent. There are many escrow-style companies who routinely complete Section 1031 exchanges, and taxpayers often find that they are the best folks to use as qualified intermediaries. There are 4 more general guidelines about properties that taxpayers must follow when doing a Section 1031 exchange, or they risk paying some capital gains. First, the value of the replacement property must be equal to or greater than the value of the relinquished property. Secondly, the equity in the replacement property must be equal to or greater than the equity in the relinquished property. Thirdly, the debt on the replacement property must be equal to or greater than the debt on the relinquished property. And fourth, all of the net proceeds from the sale of the relinquished property must be used to acquire the replacement property. Not following the Section 1031 requirements very closely can bite you. The IRS routinely disqualifies exchanges which do not follow the letter of the rules. As an example, the IRS will instantly disqualify any exchange where cash from the sale has been placed in the custody of a taxpayer during the process instead of being held in escrow. Multi-asset exchanges involve both real and personal property. For example, you might sell a hotel which includes the land and buildings as well as furnishings and equipment that's required to run the hotel. If the taxpayer wants to exchange the hotel for similar property, he would exchange the land and buildings as one part of the exchange. Then he would replace the furnishings and equipment after they've been separated into groups of like kind and like class property in a different exchange. In a situation where there isn't an even amount of like-kind property to exchange, the taxpayer treats the uneven property as boot and pays the capital gains on the portion of the exchange that property represents. Boot might also include things like mortgage boot, where the mortgage you take on the new property is less than the mortgage on the one you sold. Qualified intermediaries can often help you identify possible boot scenarios and help you mitigate the issue by adding cash to the deal. There are two time restrictions placed on tax-deferred exchanges. First, a taxpayer has 45 days after the date that the original property is sold to identify potential replacement properties. Second, the exchange must complete within 6 months of the transfer of the original property. A gotcha here is that the 6 months, or officially 180 days, might be cut short. The stated rule is that the exchange must complete within 180 days of the first sale or the due date of the taxpayer's upcoming federal tax return, whichever is earlier. Thus, for a calendar year taxpayer, the exchange period would be earlier for any exchange that begins after October 17th. You can get around this rule though, however, by filing for an extension of the tax return and pushing that date to October 15th of the next year. Failure to meet any of the time deadlines disqualifies the exchange. For instance, if a taxpayer fails to identify a replacement property within 45 days, the exchange fails and the taxpayer will have to pay any taxes arising from the sale of the relinquished property, even if he or she ends up acquiring a suitable property during the 180-day period. Some taxpayers use Section 1031 exchanges to swap investment properties that might be converted into primary residences later. Doing so means that the taxpayer can later use the homeowner's exclusion of $250,000 or $500,000 if they're married when they sell the property. In order to convert a property to be a principal residence that qualifies for the exclusion, taxpayers must keep it as investment or business property for at least a year and then wait 5 years after the 1031 exchange is completed before disposing of the property. To detail a tax-deferred exchange, use Tax Form 8824. In many cases, qualified intermediaries can give tax preparers some of the information necessary to complete that form. There are also exchange calculation worksheets available on the internet which can help you at tax time. Keep in mind that tax-deferred exchanges can be very complicated and aren't for the faint of heart. There are many variables to consider, such as time limits, debt relief, and boot. Depending on your experience as a tax preparer, you may choose to avoid complex tax-deferred exchange preparation. Giving incorrect advice, missing a date, or doing the paperwork wrong can create an extremely large, unexpected tax burden for your clients. This video has been part of a tax continuing education course available at www.aardvarktax.com. The course has been approved by the IRS and state governing agencies like California CTEC and Oregon's Board of Tax Practitioners. But just viewing the video won't get you credit for your government agencies. Be sure to register for this course or any of our other courses by heading to aardvarktax.com, and then we'll report your successful completion to the government agencies when you finish the course.